Switzerland economy Q2 productive describes a surprisingly resilient quarter in which economic growth showed continuation despite global headwinds, underpinned by services, trade, moderate inflation, stable labor markets, and a prudent fiscal and monetary stance. In Q2 2025, Switzerland's GDP annual growth rate was about 1.2% year-on-year, down from 2.0% in Q1, reflecting moderation in expansion, but still positive momentum in a challenging environment. On a quarterly basis, real GDP growth slowed to 0.1% over the previous quarter, a marked deceleration from Q1's 0.7% or 0.5% adjusted growth, but still avoiding contraction. The Q2 performance underscores that while growth is cooling, the economy remains on a productive footing rather than slipping into stagnation. These indicators together suggest Q2 delivered modest but durable productivity, setting up our deeper data dive next. In Q2 2025, Switzerland's GDP annual growth rate was about 1.2% year-on-year, down from 2.0% in Q1, reflecting moderation in expansion but still positive momentum in a challenging environment. On a quarterly basis, real GDP growth slowed to 0.1% over the previous quarter, a marked deceleration from Q1's 0.7% or 0.5% adjusted growth, but still avoiding contraction. The Q2 performance underscores that while growth is cooling, the economy remains on a productive footing rather than slipping into stagnation. The labor market in Switzerland remained robust through Q2. The unemployment rate held steady at about 2.8%, consistent with prior months and historically low levels. Long-term unemployment stayed at 1.40%, indicating that most joblessness is transient rather than structural. Participation rates improved slightly, with labor force participation rising toward 84.0% in Q2, after 83.9% in Q1, helping maintain employment levels even as activity cooled. These labor metrics suggest that Q2's productivity gains did not come at the expense of rising unemployment, and indeed, employment held up. Monetary policy entered a more neutral stance in Q2. The interest rate, the Swiss National Bank's policy rate, had been cut to 0% by mid-2025, following earlier reductions as inflation pressures dissipated. That zero rate, combined with deep negative deposit rates before the cuts, places nominal rates at the lower bound, but in real terms, Switzerland's real interest rate remained positive at about 1.67% in 2024, providing mild tightening despite low nominal settings. The modestly positive real rate helped anchor inflation expectations, support the Swiss franc, and still allow for credit flows to firms and households in Q2. Inflation in Switzerland during Q2 remained extremely low. The inflation rate, measured by CPI, stood at 0.2% year-on-year in June and July, having risen from 0.1% in June. Core inflation held close and showed little upward drift, reflecting minimal price pressures in domestic demand. In 2024, the GDP deflator inflation was recorded at about 1.29%, consistent with broader price stability. The ultra-low inflation environment afforded price predictability and maintained real income stability for consumers, helping support consumption and lending some breathing room for businesses and monetary authorities. On the fiscal front, Switzerland's sovereign debt position remained conservative. The debt-to-GDP ratio for government debt stood at approximately 37.9%, with estimates hovering in the high 30s into 2025. This modest debt level is low compared with many advanced economies and provides the Swiss government strong fiscal credibility and flexibility. Because debt burdens are manageable, public investment and discretionary spending did not face the same constraints seen elsewhere, reinforcing capacity to respond to shocks or support structural productivity enhancements. Beyond the headline indicators, sectoral performance and trade dynamics buttressed the productive claim for Q2. The Swiss economy's trade surplus remained healthy, with exports and services receipts exceeding imports. In Q2, exports of pharmaceuticals, chemicals, precision instruments and machinery contributed positively even as manufacturing contracted. Notably, manufacturing output declined by about 2.4% in Q2, led by weakness in chemicals and pharmaceuticals after a high base effect from Q1's export front-loading. Exports fell about 2.7% and imports dropped by 3.7% in value terms, softening trade flows, but preventing a severe drag. Services sectors, including finance, insurance, tourism, business services, and trade, provided stabilizing support to GDP growth when industry showed weakness. Investment activity remained steady. Gross fixed capital formation held up, driven by ongoing infrastructure, energy transition, telecommunications, and high-tech facility upgrades. While firms remained cautious, many continued to invest in automation, green technologies, and digitalization. Private consumption contributed modestly to growth, aided by wage stability, employment resilience, and weak inflation, which together preserved real purchasing power. Household demand did not surge, but remained reliably supportive rather than a drag. Credit and financial conditions aligned with the productive environment. Banks maintained solid lending flows, particularly to mortgage, commercial real estate, professional services, and innovation sectors. With the policy rate at zero, credit spreads compressed modestly, and liquidity in the banking system remained abundant. Deposit rates remained low, encouraging capital deployment into productive activities rather than hoarding, and financial conditions did not materially tighten even as growth cooled. Risks in Q2 remained visible even amid the productive narrative. The reliance on multinational firms and volatile export flows means that external shocks, such as tariff changes, global demand slumps, or exchange rate volatility, can sharply affect growth. The underperformance in manufacturing in Q2 underscores that export sectors face headwinds, and the contraction in chemicals and pharmaceuticals suggests that Q1's strength may have been partly front-loaded. Sluggish manufacturing raises questions about domestic capacity utilization. The ultra-low inflation environment also carries the risk of deflation or negative inflation surprises, especially if demand weakens further. With interest rates at the lower bound, monetary policy has limited room to maneuver downward in case of a deeper slowdown. Nonetheless, the macro foundations held strong. The moderate debt burden allows fiscal space should authorities need to respond. The stable labor market provides a buffer to absorb shocks without widespread job losses. The low inflation setup gives policy credibility and the possibility of future easing if needed. In this context, Q2's positive growth, though modest, reflects productive resilience rather than an ephemeral rebound. To restate the key figures of Q2 in the productive framing, GDP grew 1.2% year-on-year, with quarter-on-quarter growth of 0.1%. The unemployment rate remained at 2.8%. The interest rate stood effectively at 0%, with real rates positive around 1.67%. Inflation ran near 0.2%, and public debt stayed near 37.9% of GDP. These metrics together support the view that Switzerland's economy in Q2 remained productive, expanding gently in a disciplined, stable, and sustainable manner despite external and domestic headwinds. In conclusion, Switzerland's Q2 performance combines modest but stable output growth, labor market resilience, prudent monetary policy, ultra-low inflation, and a conservative fiscal profile. While manufacturing faltered and trade softened, the strong services backbone, investment momentum, and fiscal strength prevented a slide. The challenges ahead are real: external volatility, rate flexibility constraints, and sectoral imbalances, but the Q2 result reveals an economy capable of producing positive growth under difficult conditions. In short, Switzerland navigated Q2 2025 not with explosive expansion but with capable productivity, anchoring the broader narrative that advanced economies need not decelerate sharply to remain productive. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.